Hello everyone, and welcome to your Glassnode video report for week 30, 2023. We are beyond Bitcoin block height 800,000. Now, of course, this means absolutely nothing. Block 800,000 is just another block, but it is pretty impressive when you see that Bitcoin has been around for 14 and a half years. It settled $109 trillion in terms of total value and UTXO value spent, over 867 million transactions. I mean, this thing is a pretty remarkable beast to be still going. So some really, really fun stats exist out there on just how far Bitcoin has come. So there is a Twitter thread that you'll find in the description below where I kind of covered some of the different, just interesting network statistics to really reflect on. But anyway, what we're going to be looking at today is a topic that, generally speaking, is a very, very hard one to analyze properly. It is a very nuanced and very complex topic. So we are going to be touching on whale watching. And whale watching, generally speaking, there's lots of people who like to track addresses and, try and track what the big money is doing. The challenge is that quite often we get confused between which addresses are whales, which ones are exchanges, which ones are ETF products. And as the market matures and those types of things, ETFs and the like expand, this is only going to become more dynamic and more challenging. So it is a very nuanced topic, but we are going to touch on some really interesting and bizarre things that are going on within this cohort, which kind of necessitates a bit of a view. So whale entities are often cited as the big players moving around markets. And yes, of course, if you have a large stack, there is going to be a degree to which you can influence the market more than the pleb. But what we are going to be looking at today is just kind of unpacking the information, taking in a lot of the data that we see, and just trying to distill down some simple tools. Because the thing is, there's so many parts of this puzzle that are very complex and very nuanced. And quite often people get caught up tracking individual transactions. And, sometimes the market reacts to it, but quite often they turn out to not really have much relevance at all. So what we're really going to focus on doing is building out a couple of tools, particularly using correlations, to try and identify more or less like a filtering device. When do we actually need to pay more attention and look into it a bit deeper? So it's more about looking for those areas where it really does show up and say, okay, maybe something interesting is happening. And on the other instances, perhaps we can use that as a bit of a filter to say, well, maybe we don't really need to pay attention to that headline about whales, doing whatever whales are doing. So anyway, before we do get started, please do give us a rate, a share, and a subscribe. It does help this channel. As always, let me know if you've got any questions, comments, or thoughts. Always happy to answer those, and let's get stuck right into the analysis. Okay, so we are going to start up in the Glassnode engine room. And in fact, because we're literally looking at entities, whales, exchanges, almost every metric we look at today will be focused on our T3 plan for professionals. So this is really some of our most nuanced data, some of the stuff that really gets down in the weeds, trying to track entities to exchanges and really taking the maximum advantage of our clustering and all the labels that our data science team is building up in the background. So we're going to start in the Glassnode engine room, which is one of our dashboards that has a lot of quite bespoke and metrics that are really quite challenging to either compute or to get into Studio and actually chart these things. So engine room's kind of an area where we do a lot of these exploratory metrics and kind of building up these ideas fairly early on. So this is the trend accumulation score. And a very, very high level, we've got the smallest wallets, 1, 10, 100 Bitcoin down the bottom, and all the way up to 10,000 plus. So these are kind of our entity groupings. What we're looking at is over the last 30 days, and that's an important note, over the last 30 days, how much has that group's balance increased, going blue, or decreased, going red? So it is all it's relative to the last 30-day period. What is the net change of these different wallets? Now, the reason why this is an interesting way to study the market is because there are, well, at the moment, 19.4 million Bitcoin, but at the end of the day, there'll be 21 million. And a coin is either in a whale balance or it's not. It's either in a shrimp balance or it's not. So these things they're not binary because there's more than one wallet grouping, but they're either in one set or the other. We've kind of got a closed system and coins are moving around between different entities. And quite often, by the way, exchanges will sit in the middle of this as kind of the area where these coins will pass through, certainly in the way that our metrics are constructed. Now, really, we're going to be focusing only on whales here. And the important part is you can see there's this interesting divergence. This is kind of the first thing that we noted that set us off on this exploration. Our 1K to 10K has moved into what would be presumed to be accumulation in this blue zone. But then our greater than 10K is seeing distribution. So we're kind of in this realm where it's like, okay, hang on a second. We've got greater than 10K wallets are distributing, and we've got 1K to 10K which are accumulating. And you can see that they've kind of got a similar pattern. They're almost operating in tandem. So this is kind of the first port of call, and really why we kind of hone in on the whale cohort. You can also see that even in our current environment, they are the ones who are kind of seeing the most volatility and change. It's very neutral across the board for everybody else. So just to give you a bit of context, and I would recommend if you haven't read it already, we did a very, very comprehensive report on everything from shrimps all the way to whales. A lot of the nuances we captured in that report called the Shrimp Supply Sync. Again, you will find a link in the description below. And what we really showed in that report is that over the macro scale of Bitcoin's lifespan, the whale cohort, so to speak, being those with more than 1,000 Bitcoin, they have seen their balance decline year after year after year. This is a multi-year trend. And this, by the way, includes exchange addresses. They are built into this particular chart we're looking at the moment. So you can see we're looking at the entire supply from 0 to 100%, how much is held by these whale cohorts, right? And just remember, this particular data set includes exchanges in this grouping. So it's all wallets with more than 1,000 Bitcoin. So just for a quick sense of scale, it was about 73% back here in the 2013 peak. We're just going to use the market peaks as our reference point. This whale grouping held around 73% of the supply. When we got, by the time we got down to the 2013 market, we had something closer to 62%. By the time we got to our 2017 market, it was 52%, and that was pretty much flat. It was about, was it 53% in the 2021 bull? And where we currently are, we're down at about 42%. So the macro scale is that these whale entities are actually net distributors over the long arc of time. Now, it is also quite important to remember that this includes exchanges, ETF products, lost coins, Satoshi's coins are in here, all of these entities that have these large allotments. So when you really factor those groupings out, this thing here is and that's what we did in the Shrimp Supply Sync report, this thing is a big macro decline. So the Bitcoin supply, as much as the critics hate to hear this, the facts of the matter is that the coins are being increasingly distributed over time. So it is kind of interesting when you put the data versus the narrative, and it certainly upsets many in the traditional finance space. But that's, at the end of the day, it's kind of what we're here for. So now what we're going to do, we saw in that first chart that we had a bit of a divergence between let's call them the small whales and the big whales, right? So there's a bit of a divergence. They kind of seem to be equal and opposite. If we look at their three different balances, right? This is in BTC denomination. You can see back here that we had a bit of a divergence, right? These very large whales, 100,000 plus. This was kind of the GBTC era, right? Lots of coins flowing into ETF products, and Michael Saylor and all of these elements are playing into it. But you can see that really over the last little while, there hasn't been a great deal of divergence. And even during recent weeks, there's been a little bit of a downtick, about 40,000 Bitcoin a month, if I'm not mistaken, in this kind of middle cohort. But we've seen an equal and opposite uptick of about 30,000 Bitcoin in the smaller whale cohort. So again, we're kind of seeing this very micro scale, but equal and opposite divergence. Now, a nice way that we can actually plot and chart this out is saying, okay, let's use our net position change. So the net position change is we use this all the time at Glassnode. And by the way, it's a really, really powerful metric. We use it all the time using the diff function in Workbench. It's fantastic when you're looking at supply-based metrics. So if we want to compare two different groups of, let's say, whale supply, here we're looking at 1K to 10K and then 10K plus, the same groupings that we saw back in the first chart. And we're just looking at the 30-day change. How much did those aggregate supplies of whales change over the last month? Now, what we've essentially got here is you can see that there's some periods of time, like where we currently are, where we have kind of an equal and opposite, where one group is declining, the other group is increasing. And what we've used down the bottom here is a bar, and we're basically looking at this from a correlation standpoint. When there is a negative correlation of minus 0.5 or less, so really getting into that kind of inverse relationship type territory, this thing here will show up as a green level. Now, what we've called this metric is a whale reshuffling. And what we're kind of trying to assess is, are those whales actually just breaking down their coins, going from a 100,000 wallet or a 10,000 wallet into several thousand wallets? Now, the nice thing about this is that our clustering algorithm will pick these up. So it's going to be able to identify where these different coins are going, and if they're all owned by the same person, they're just breaking them down. What we're looking for here is this kind of reshuffling type behavior. Are they really distributing? Are they really selling or buying? Or are we actually just seeing coins kind of shifting around and moving around the network for whatever purpose that may be? And we have to remember that exchanges are often the middleman for these transactions. Coins will often flow into an exchange and then out because they kind of act as a little bit of an anonymizer, because coins can flow in, but it's very hard to then see it. The same coin doesn't flow through Binance and then come out the other side. It comes from the exchange's hot or cold wallet. So what we're kind of seeing is that exchanges often get used to kind of obfuscate where these funds are going. They're kind of like a bit of a gray box that sits in the middle. So the big takeaway from this is that we can see that there is, on net, if we look at overall in terms of these groupings, there appears to be a high correlation, a high inverse correlation, which suggests that there may be some reshuffling that's going on, right? So that's kind of a first takeaway. Now, to try and address this exchange problem, and as I said at the start of this session, this is why whale analysis is very, very complex, very, very nuanced. What we're looking at here is the whale volume. This is a 30-day change. Again, we've got the net position change here in purple. Really, really powerful tool. But what we're looking at here is only coins flowing in and out of exchanges. So we've essentially calculated a balance. That's what the orange curve in the back here. This is basically all outflows to whales minus all inflows, right? On a cumulative sum basis. So think about an outflow from an exchange to a whale as an acquisition. And when a whale sends coins to an exchange, that's going to be an outflow from the whale to the exchange. So what we've then calculated is essentially like, imagine this is like a purchased balance. Now you can see that we have an extraordinarily large 30-day change in this whale, call it acquired balance, down 147,000 Bitcoin a month. That's a significant chunk of coin, right? We're talking about an entire MicroStrategy here that has essentially left whale wallets and gone into exchanges. So again, we're starting to get this thing where, okay, there's an inverse correlation between these small and large whales. Price, I mean, it's kind of traded sideways and very, very quiet. We've covered this over recent weeks. It's just so quiet out there. So it's kind of interesting to see this magnitude of coin volume moving around, right? An entire MicroStrategy has flowed into exchanges, and yet the whale balance hasn't really changed that much. It's kind of equal and opposite in two different directions. So it's starting to get a little bit interesting, right? There's a few pieces of the puzzle that we can try and dig into here. Now, this metric is then looking at it in terms of a total inflow, so whales to exchanges. If whales are sending coins to exchanges, this thing here is going to be green. And if whales are withdrawing from exchanges, it's going to be red, right? This is kind of looking at it from the whale's perspective in terms of an inflow and an outflow. From the exchange's perspective. So inflows are green, outflows are red. Now, again, these charts can get quite noisy. You can obviously see that there's a lot more volatility and activity around high volatility sell-offs and market tops and all that kind of thing. But quite often, there's things that just stand out with this data. And, I like to look for things that just stand out and go, oh, that's a little bit interesting and that's a little bit different. And to me, the net flow line, this black curve that we've got here, you can see it has been elevated for about 2 months. It has sustained a high level of inflows for a substantial period of time. So again, we're really starting to piece together there is something going on between the whales and the exchanges. And this is where we also know that the exchanges are kind of this centerpiece where coins are kind of flowing in and then flowing out to go somewhere else. And this is probably the most intriguing. And again, I'm not going to be able to have all the answers here. We're certainly just trying to look at some of these dynamics and just trying to set the stage for how we can analyze these market structures. This is one of the most interesting charts I've seen in a very long time. So what we're looking at here is this is like a dominance chart between 0 and 100% of all of the inflow volume to exchanges. So we only care about whale deposits to exchanges. Of all that volume that's flowing in, which exchange is it going to? Well, we know that Binance is a dominant force. It is the largest exchange by almost every metric, whether it be by coin balance, whether it be by trade volume, customer base, all of these things. Binance is the largest entity when it comes to centralized exchanges in the space. And what you can see here is that Binance currently accounts for about 82% of all inflows from whales to exchanges. Now, we're not talking about 82% of all inflows. We're talking about this only from the whale cohort. So whales are primarily, and at an accelerating rate, depositing coins to Binance. Coinbase is here in blue. That's kind of giving you a sense of scale and magnitude. So whereas Binance is 82%, we're talking about 7% going into Coinbase. And the gray is pretty much everyone else, about 11% thereabouts. My math is correct. So again, we don't have all the answers here, but we're just trying to piece together. There is something really interesting going on when it comes to whales sending coins, apparently largely to Binance, right? So we're kind of taking advantage of all these different labels and all these different clusters to just try and paint a picture of what's going on. And meanwhile, this is happening. You can actually see when this really starts to spike higher. This is happening when price has basically done absolutely nothing for a month. So it's a really interesting dynamic. But there is kind of the next layer to this, which is what does it really mean when it comes to market structure? What else can we really understand about the profit and the loss, and what's the actual behavioral incentives that are going on? So that's where we're going to leave it in terms of the whale kind of volume flows. But what we're now going to do is just assess this from a bit more of a market structure perspective. So in our report last week, what we covered was the overall flow of coins in and out of exchanges, and how it was very, very interesting how short-term holders here in red have seen a significant uptick. Again, we try to look for these things that just stand out as being like, oh, that's a little bit different. That appears to be a bit of a shift or a change in market structure. So what this chart is looking at is all exchange inflows, right? So the orange curve up the top here is all exchange inflows. And then what we've done is we've shown the breakdown. The red is then the component of that that's short-term holders, coins that are younger than 155 days. And again, the reason why we use this is because statistically speaking, that kind of age threshold, about 5 months, a coin is statistically much less likely to be spent when it's survived or it's been held for at least 5 months. Much more likely to be spent when it's younger than that. And the younger a coin is, the more likely it is to be spent. This is like a very consistent curve. It's been replicated across many different age groupings and by many analysts. So it's a kind of a common thing that we see across the Bitcoin network. In the green, we have inter-exchange flows from Binance to Coinbase, from Coinbase to OKX. These are kind of inter-exchange flows. And then down the bottom here is our long-term holders, people who've crossed that kind of, hodler threshold. And they are, as you can see, a much, much smaller component. So generally speaking, a lot of the day-to-day trade in spot markets is driven by short-term holders and coins flowing between exchanges, which again is going to be that trader, short-term holder type cohort. But notable is this significant uptick in short-term holders. So again, we've got whales who are clearly sending a lot of coins in, and they also, you can see very, very little uptick in long-term holders. So really the takeaway here is that this appears to be short-term holder whales, right? We're just trying to further classify this problem. Now, this thing here is then looking at, of all the exchange inflows, what is the dominance of short-term holders? And what's fascinating, again, we're looking for these big breaks in structure. We have seen that basically since 2018, it's been between 55 and 65% of all inflow volume has been by short-term holders, right? This is a really stable multi-year baseline, right? Of course, day to day that you can see in the background, there's a lot of volatility, but over some kind of meaningful moving average, it's pretty smooth, except for this significant break higher. So again, something very intriguing is going on. It just kind of, it helps us understand where we can pay attention to these things. There is something going on in terms of these flows. They appear to be large size. They appear to be flowing into exchanges, and they appear to be flowing into Binance. And of these coins, the vast majority of them last transacted within the last 155 days, making them short-term holder coins. So there's something happening of late that's really kind of getting our attention here. Now, there's another layer to all of this, and this is where we start moving into kind of understanding a bit about how market structure works and how the on-chain space can help inform what's going on in spot markets. So from my experience studying these, how these markets work and really trying to assess how on-chain data helps us understand the mechanics, I often turn to the profit and loss grouping, realized profit and loss in particular. And the logic is, right, we've been in an uptrend in 2023. There are going to be people who invest and take profits. And what's really interesting about profit and loss is it's very much in the market psychology camp. And as someone who's kind of been learning a lot about market psychology, It's very much about knowing what the smart money is doing, which is typically a smaller cohort. And then you've got what the rest of the people are doing. And quite often, that tends to be what the majority tend to do, is to be on the wrong side of the boat. They tend to do the exact wrong thing at the exact wrong time. So what we see during uptrends, and we kind of put this into the uptrend type psychology. We see this very consistently, and it's almost perfectly reversed in a downtrend. We see that profits, this is only short-term holder coins to exchanges. Note that our short-term holder profits spike higher on the rally. This is literally profit taking. Coins get sent into exchanges, and that profit taking is actually what establishes these local highs. So we see that there's kind of this trading cohort that sends their coins in and actually takes profits, which is the thing that puts these local tops in place. Now, the other thing is that why short-term holders are particularly interesting is because we're now more than 5 months into 2023. And if we consider this particular part of the market, we still get short-term holder losses. And yet the only way you could hold your coins for 5 months and be at a loss is if you bought the local highs. So what we see here is that the local high buyers actually sell at the bottoms. You see an uptick in losses by the short-term holder cohort when we get to kind of the worst part of the correction. So in many ways, it starts to fall into that almost contrarian style thinking. So you see the profit taking that puts the local high in, and then you see a bit of a micro capitulation that happens on the way back down. And this is where it really helps us understand these kind of market dynamics and how the market is, how investors are moving their funds in and out of exchanges in particular. So what we've just done there is switched over to short-term holder SOPR. And this is one of the most powerful tools that we really have. Certainly when it comes to just kind of understanding these market dynamics, SOPR it's a powerful metric. It's been around, there's different variants of it. It's been around for a little while. It's essentially not looking at profit and loss in terms of dollar terms, which is what that previous chart was looking at. This one here is really looking at it in terms of the kind of like a profit multiple. So it's looking at the ratio of price of disposal and price of acquisition, and it's taking an average across the short-term holder cohort. Now, you'll often see when we're doing our analysis that we apply a statistical band. So we just do a mean plus a standard deviation, right? So it's kind of just a typical one standard deviation band. Here we're looking at on a 90-day period. And the reason why it's a 90-day period is that if you do it on a longer period of time, yes, it will be better for that kind of long-term time horizon. But I think we can all agree that the last 90 days has been quite different to the 90 days a year ago. This was a significant and fairly brutal downtrend. 2023 has more or less been an uptrend. So in that sense, we're just going to look at this on a shorter term time frame. And what we're looking for is periods of time when the profit taking is larger than that 90-day one standard deviation band. We're looking for periods of time when the market takes a lot of profits relative to the recent market structure. Likewise, we can have one on the lower side, right? One minus standard deviation. And we're looking for those periods where the losses kind of exceed what we've seen over the last 90 days, statistically meaningful. And you can use this confluence. Let's just flick back for 1 second. You can see that we've got our peaks in profit near these local highs. We get our peaks in losses near these local lows. So now let's switch again to our SOPR metric. Very, very similar point in time when you get SOPR pushing outside these standard deviation bands on both directions. So again, it's helping us just quantify what is kind of typical market behavior within whatever context we're looking at it, in this case, a 90-day period, and just looking for those statistically meaningful things that go, we should pay attention to what's going on at this point in time. And the last thing that we're going to do is essentially distill both of those two observations. That first one we looked at, which was profit and loss in terms of like dollar terminology, we do a bit of normalization, but it's more or less the same calculation. And when SOPR is above that one standard deviation band. So we're only looking at things that are in the profit-taking regime here, but you can start to see that we can look for confluence. We're looking for two different sets of tools that are saying that there is a significant amount of profit that has been taken by the short-term holder cohort. So it's trying to just contextualize and really give us a bit of a tool set and a way to think about these things, how we can normalize the data, how we can look at statistical bands and really pass these things into more actionable information and really pull insights from what's going on in the market. So kind of an interesting piece, right? We're really looking at that journey from whales. Something's going on in terms of their balances. Okay, now exchanges appear to be some part of the mix. There's coins flowing in and out. We can then determine that they're short-term holders because that kind of correlates between the short-term holder behavior and what's going on with the whale cohort. And then from that kind of strange and weird journey, we finally end up with an indicator that can help us spot when these events are happening, certainly when it comes to the profit taking. And naturally, you could look at this on both sides of the equation. So thanks for tuning in for that session, folks. As always, let me know if you have any comments or questions. More than happy to answer those. So, it's kind of an interesting dynamic, certainly something to pay attention to. Hopefully, we've kind of given you a few more ideas about how to think about these things. Certainly, we find looking for tools that just help filter signal and noise. And quite often that will be, normalization techniques or standard deviation bands or what we looked at with the whale cohorts, correlations, just bringing in these tools to help filter out what is a meaningful piece of information, how to really distill it down and actually turn it from a set of data into something that's really actionable insights. So hopefully you enjoyed that one. Let me know if you've got any comments and I'll see you in the next one. Cheers.